Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Liquidity Risk Management. Liquidity risk management is a critical element of asset liability management, particularly for financial institutions and corporations. Liquidity risk refers to the possibility that an entity will not be able to meet its short-term financial obligations due to an inability to convert assets into cash without a significant loss in value. Effective liquidity risk management ensures that an entity can meet its payment obligations, both expected and unexpected, without incurring unacceptable losses. This lesson delves into the importance, strategies, and tools for managing liquidity risk, substantiated by empirical evidence and theoretical frameworks. Liquidity risk arises from mismatches between the maturities of assets and liabilities. Financial institutions, for instance, typically borrow short-term funds to finance long-term loans. This maturity transformation exposes them to the risk that they may not be able to refinance their short-term liabilities as they come due, or may have to do so at exorbitant costs. The 2007-2008 financial crisis serves as a stark illustration of liquidity risk. During the crisis, financial institutions faced severe liquidity shortages, which led to a cascade of bank failures and required unprecedented interventions by central banks and governments. One of the primary methods for managing liquidity risk is through liquidity gap analysis. This involves mapping out cash inflows and outflows over different time horizons to identify periods where there might be a liquidity shortfall. By forecasting these gaps, financial institutions can take preemptive actions such as adjusting their asset-liability mix, securing backup lines of credit, or holding higher levels of liquid assets. For example, a bank might increase its holdings of government securities, which can be quickly sold in the secondary market if a liquidity need arises. Another crucial tool in liquidity risk management is the liquidity coverage ratio, introduced under the Basel III framework. The LCR requires banks to hold a buffer of high-quality liquid assets sufficient to cover net cash outflows over a 30-day stress period. According to the Bank for International Settlements, the LCR is designed to ensure that banks can withstand a significant stress scenario, thereby protecting the overall financial system. A study found that the implementation of the LCR has significantly improved the liquidity positions of banks globally, reducing the likelihood of liquidity-driven failures. Stress testing is another vital component of liquidity risk management. It involves simulating various adverse scenarios to assess the potential impact on an institution's liquidity position. These scenarios can range from market-wide disruptions, such as a sudden spike in interest rates, to institution-specific events, such as a major operational failure. Stress tests help institutions to identify vulnerabilities and develop contingency plans. For instance, during the European sovereign debt crisis, many banks conducted stress tests that revealed significant exposures to peripheral European countries, prompting them to take corrective actions to bolster their liquidity positions. Central banks also play a pivotal role in providing liquidity to the financial system, acting as lenders of last resort. During times of systemic stress, central banks can inject liquidity into the banking system through various mechanisms, such as open market operations, discount window lending, and emergency liquidity assistance. For example, during the 2007-2008 financial crisis, the Federal Reserve implemented a series of measures, including the term auction facility and the primary dealer credit facility, to provide liquidity to banks and other financial institutions. Effective liquidity risk management also involves robust governance and oversight. Institutions must establish clear policies and procedures for managing liquidity risk, with defined roles and responsibilities. This includes setting liquidity risk limits, monitoring liquidity positions regularly, and reporting to senior management and the board of directors. Strong governance ensures that liquidity risk management is embedded into the institution's overall risk management framework and that there is accountability for managing liquidity risk. In addition to internal mechanisms, external market conditions and regulatory requirements significantly influence liquidity risk management. Market liquidity, which refers to the ease with which assets can be bought or sold without affecting their price, plays a crucial role in determining an institution's ability to manage liquidity risk. During times of market stress, liquidity can dry up quickly, making it difficult for institutions to sell assets or raise funds. Therefore, institutions must continuously monitor market conditions and adjust their liquidity strategies accordingly. Regulatory requirements, such as the Basel III framework, have also enhanced the focus on liquidity risk management. Apart from the LCR, Basel III introduced the net stable funding ratio, which aims to promote more stable funding structures by requiring banks to maintain a minimum amount of stable funding relative to their assets and off-balance sheet activities over a one-year horizon. These regulatory measures have led to a more disciplined approach to liquidity risk management and have contributed to the overall stability of the financial system. To illustrate the practical application of liquidity risk management, consider the case of Northern Rock, a British bank that experienced a severe liquidity crisis in 2007. Northern Rock relied heavily on short-term wholesale funding to finance its mortgage lending. When the wholesale funding markets froze during the financial crisis, Northern Rock was unable to refinance its short-term liabilities, leading to a run on the bank and eventually its nationalization by the British government. This case highlights the importance of maintaining a diversified funding base and holding sufficient liquid assets to manage liquidity risk effectively. In conclusion, liquidity risk management is a fundamental aspect of asset-liability management, particularly for financial institutions. Effective liquidity risk management requires a combination of quantitative tools, such as liquidity gap analysis, the LCR, and stress testing, as well as qualitative measures, including robust governance and oversight. Market conditions and regulatory requirements also play a crucial role in shaping liquidity risk management practices. By understanding and managing liquidity risk, institutions can ensure their ability to meet short-term obligations, maintain market confidence, and contribute to the overall stability of the financial system. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UXL, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.